Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. New trading week, new trading month as we tape here on the 1st of June, 2009. Market making new highs as we speak, apparently already putting the GM bankruptcy in the rearview mirror. We'll see how our analysts here feel about that, and at least a couple of dozen other things, I'm sure. Steve Reitmeister, editor-at-large, is with us, as is Charles Rotblatt, our senior market analyst, and our top market technician, Kevin Matris. We always throw in, everything but the kitchen sink on these things, and that's what makes them so popular on the World Wide Web. So stock market's making new highs.
Right.
Yeah, why?
Pretty exciting.
I mean, I can't figure out why. We've got news of a bankruptcy, which normally is bad news. I mean, GM, big powerhouse, right? I can't figure this out.
The one thing about GM is that everybody has known about this for months, right? So it finally happening has taken away a lot of the uncertainty surrounding what indeed was going to happen with GM. But why is the market moving higher? Look, earlier this year and really last year, everybody thought the market was going to fall into the abyss. It hasn't. The market has been able to make a steady comeback. Granted, earnings were kind of crummy last quarter, but everybody is believing that business has tightened up a chip. I think the reason why companies did so good last quarter is because they really were able to rein in spending. Now the hope is that as the economy gets better, you're finally going to see companies actually produce real sales growth. I think there's a tremendous amount of relief in the market. And since the market is forward-looking, typically moving higher 6 months prior to the recession ending, I think everybody is getting ready and they're buying equities because they do believe things are going to be better as we move into the future.
So you took all of that time to say that the market's discounting the GM news.
Pretty much. I mean, look, the GM is going to emerge from this bankruptcy, for all intents and purposes, a stronger company. Yes, there's a lot of wrangling over how the government is going to try to run GM. I don't think the government wants to run GM, but I think everybody is confident, or at least is hopeful, that GM will emerge a stronger company. So people are putting this in the rear view mirror, if you will. Plus, too, GM is not as important of a company when you look at overall GDP nowadays as it used to be 20 years ago. But nonetheless, I think they are putting all of this stuff into context, and people are buying the stock market because of future optimism.
Charles, what do you think? Market breathing a sigh of relief here now that the details are known?
Well, it's interesting. We talked about this right before we started filming, that the new rules are that if you dilute your shares substantially or if you go bankrupt, it's evidently good for the market. But I think the underlying thing is that we're seeing the rate of deterioration slow. This morning we had the new ISM report coming out, and I just want to give some of the quotes because it's a pretty good snapshot of what's going on in the economy. Business is actually better than planned. Realistically, we don't see any of our major customers looking to place business until mid-2010. April was flat on trend. Business was still trending downward, but not as fast. So therefore, you're saying, okay, the economy's still in a recession, but things are actually looking a little bit better. And obviously last week I used the golf driver analogy, and I do think we're...
Don't come back to that one. He spent all the previous week on that golf driver analogy, and he's coming back. Don't do it.
It's a great analogy. But I think what people need to understand is that the economy actually is not as bad as everyone feared. It looks like the worst case scenario is not going to happen, and that's giving the markets a lift. We're seeing earnings estimates continue to be revised higher. And I think everyone's looking at this with the big expectations, and we're seeing this in the consumer confidence numbers as well. There's this massive expectation that things will be better in the future. We've passed the eye of the storm, and that although there's still going to be damage, it's the worst of it's over.
One thing, though, that you don't like is now that GM has been replaced in the Dow, you don't like who they chose to replace it with.
No, I don't. I think they would have been better off going with maybe a Monsanto and a Google, and the reason for it is really construction of the Dow. Who's already in there? Cisco's been a prime candidate for a long time to be in the Dow, and although it's really hard to argue against Cisco being in there, you look at Google with its internet search engine and its mobile phone operating system, very big, addition to the Dow that would have made a lot of sense in terms of the Dow being representative. Monsanto is just a play on the commodities. When you look at worldwide population growth, there's just going to be higher demand for agriculture. And I think adding those two companies into the average would have made the average really more representative of the overall U.S. economy and where it's shifting in terms away from a manufacturing base to really a knowledge-based economy.
So what part of what you heard so far do you want to take issue with?
No, we've had this as an ongoing discussion over time, and we were all very bearish in 2008, the beginning of 2009, and Kevin probably was the first to kind of say, hey, I see greater possibilities in this market, and Charles and I held back a little bit. But yeah, as we see some earnings improvement or earnings stabilization in terms of the estimates, that's why Charles and I are not as bearish as we perhaps once were. So fundamentally speaking, I believe the market is appropriately valued. I don't see a good case for it to go much higher, fundamentally speaking. Technically speaking, the reason why the market is pushing higher is because everyone and their mother said it would retreat. Right. Okay? And so the market likes to suck us all in, make us all look as foolish as possible. And so here again, everyone who was waiting for that next leg down, I'll wait until I jump back in, which didn't really happen. And here again, a lot of smart people thought that was the case. So now, as the market presses towards its 200-day moving average, I wouldn't be surprised to see it crack that, and everyone says, okay, there's not going to be that leg back down. I have to jump in, and that's when the bear trap gets set.
Or not.
Okay. No, or not, right. Or not. But I'm saying, I think that it has to press a little bit higher to suck in all that sideline money. The market likes to make a fool of us all. And that's when a bear trap gets set.
And we've always got the golf driver analogy to fall back on if we have to. So the question now becomes, Charles, I'll start with you because you seem to have an idea here about what investors should be doing. Now, you always have an idea about what investors should be doing at any one time.
Well, I can tell you what we're doing actually with our portfolios, particularly with the Zacks Elite Focus List. We're buying. I came out 2 weeks ago on the site saying we're buying in those exact words. And what we're doing in terms of adding stocks is we're not being overly aggressive. We're looking around. We're looking at some sectors where we didn't have an exposure. For instance, financials. We didn't have any financial stocks in there. In the past 2 weeks, we've added 2 financial stocks. But when we're adding stocks, we're looking at the fundamental picture to make sure that the companies have sound business plans. There's a legitimate reason for these companies to do better, and we're keeping an eye on valuations. And I think the big thing for investors to understand is that the risk tolerance has changed. People are no longer as risk adverse as they once were, and that's contributing to the rise. And so I think if people have been sitting on the sidelines, start taking a look at your portfolio, see what you don't have exposure to, see if there's some good bargains in that sector, and then buy it. I wouldn't chase necessarily, but at the same time, I wouldn't avoid a stock because, say, it was trading at 20 in early March and now it's at 35. If it's still a screaming value at 35 and you really think the stock's worth 50, buy it. But don't buy a stock that's just risen up because all the bad news has been released and people are like, well, shares have been diluted, business is in the tank, but the doors are still open. That's not a reason. You want to buy the companies that are doing well, not the companies that just happen to keep their doors open until the federal government decides to take them over too.
What do you think?
There's some excellent points in there. What happens is that the first part of this rally, really the companies with the good earnings were the ones that weren't rising. Right. It was a lot of speculation. The home builders rose, the banks went up, and just because they didn't shut their doors, it was the only reason why they went up. Now I think there is a little more consideration for, okay, let's take a look at all companies and how healthy their earnings outlooks are, and I think that you're seeing a lot of good and normal companies rising and not just the speculative ones. Right. Now here again, I kind of gave a little prelude to what I'm thinking here on the market in terms of, I think we can shoot higher. We can maybe even shoot over 9,000, 9,500 perhaps before the bear trap gets put on everybody. But here again, bear trap, I don't mean 6,500. So I was being a little sensational there a minute ago. But would it be reasonable to retreat back to 8,000? So if you get up to 9,500, you retreat back to 8,000. It's going to be scary. It's going to be like, oh, how much farther are we going to go? And because that's going to be a 15, 20% dip. So here again, trading, I think we got a little upturn impetus. There will be a down leg, but if you're looking past the horizon, a longer-term investor, there are absolutely good companies that you can buy right now who have real earnings. They survive the economic downturn. They have a good outlook. There's reasonable valuation to them, and you'll be fine even if there's a down leg on them.
Right. Kevin, what advice do you have for investors?
You know, Charles was talking about the investor is willing to take on more risk, and you can see that in the recent State Street Investor Index. That shows, you know, portfolio managers willing to take on more risk, which means them getting into equities. What's interesting, though, is there still is a tremendous amount of money still on the sidelines. And I think just like the market overshot itself on the downside, right? I think the market has just as good of a chance, if not a probability, of overshooting its upside targets. The markets always seem to do that. So I think it's possible to see the market not only get to 9,000, 9,500, I think it's possible to see the market get to 10,000. And I think some of the best places to be right now would be looking at basic material companies, heavy construction companies. I've said this in the past. A lot of the stimulus money is going to be coming into the economy very, very soon, and I think these companies are going to benefit in a big way.
All right. And our online unit, Zacks.com, has other commentary and stock pick ideas for you. I want to remind you that you can always go there and take advantage of all of the latest news and reaction to it right at Zacks.com's homepage. With everyone here, I'm Terry Ruffalo.